Hello, my name is Magnus Petersen. This talk is about the S&P 500 versus US government bonds. The talk is based on this book, and you can click on the image or on the link below the video. So what is a government bond? You can buy a so-called bond from the government of the United States, and after a so-called maturity period, the US government repays you the money for the bond plus interest. So you are effectively lending money to the US government. The interest is also called a bond yield or return. For example, if you buy a bond for $1,000 with a 1-year maturity and 5% yield, then after 1 year you get $1,050 in return. This is the original $1,000 you invested plus $50 in interest. Bonds with maturity less than a year are often called treasury bills, but I will just call them for bonds. This plot shows a yield on US government bond with 1-year maturity. And as you can see, it changes over time. So in January 1980, it was over 12%. And then in January 1990, it was over 8%. In January 2000, it was over 6%. And in January 2010, it was about 0.4%. So what happens if we invest in these government bonds in multiple years? For example, let's say you buy a bond for $1,000 with 1-year maturity and 5% yield. And after the first year, you get $1,050 in return. Let's then say that the yield has changed to 8%. So you reinvest the $1,050. And after another year, you get $1,134 in return. And this means you have earned a total of $134 on your original $1,000 investment, which is a total return of 13.4% over 2 years. The so-called annualized return is about 6.5%, and it is a kind of an average, so that if you get a return of 6.5% for 2 years in a row, then it compounds to 13.4%. You can see the book for a formula on how to calculate annualized returns. It is not just a simple average. So let us consider all possible starting dates and investment periods up to 10 years during the years 1978 to 2013. This is a box plot that shows statistics for the annualized returns depending on the years of investing. In this case, the spread is quite low for the annualized returns, so it is a bit difficult to see in this plot, and I will describe the box plot on another slide in more detail. This can also be shown as a table instead, where it's easier to see. So here we have the number of years of investing going from 1 up to 10. And here we have the minimum annualized return in this column here. We have the maximum over here. We have the first quartile, the third quartile, and the median and the mean, and the standard deviation. And the probabilities will be described in another slide. So for all possible starting dates and investment periods of 1 year, the minimum annualized return was 0.08%. The maximum was 17.3%, and on average, it was 5.8%. But if we have investment periods of 10 years, then the minimum annualized return over those 10 years was 1.8%. The maximum was 10.4%. And the average was 5.6%. The S&P 500 is a so-called stock market index which contains 500 large US companies, and at this point in time it consists of Apple and Microsoft and Walmart and other large companies. And the price of the S&P 500 is shown in this plot for the period between 1978 and 2013. As can be seen, it is quite volatile, and the greatest annual gain was over 70%, and the greatest annual loss was almost half, or almost 50%. So this is another example of a box plot, and it's easier to see here. So what we have down here is the years of investing, and this is for the S&P 500. So we consider all starting dates in this period and investment periods up to 10 years. So for example, we consider starting here 1st of January 1990, or one of the first days in January, and investing 1 year and reinvesting the dividends on the S&P 500 then investing another year, reinvesting the dividends, and so on. And we also consider the another starting date, let's say 2002. So we have the 10-year period starting here and going over here. And we do this for all starting dates and periods up to 10 years. And then we summarize the statistics using this box plot. So for 1 year investment periods, we have a median annualized return of maybe 14%. And the lowest is down here, and that is almost minus 50%. And the greatest is more than 70%. And if we have an investment period of, let's say 6 years, then we have almost no losses. So the annualized return is, there are only a few of them that are smaller than zero, and they are only like minus 2% or so. And the greatest annualized return is something like 25%. And the median is maybe, I don't know, 12 or 13%. So this can also be written as a table, and it looks like this. Again, we have the years of investing out here in this column, and we have the minimum annualized return here, the maximum here, median, mean, and the third quartile and the first and the standard deviation, and I will describe the probabilities on another slide. So again, we can see for 1 year of investing, the lowest annualized return was minus 46.8%, and the greatest was 71.8%. On average, it was 12.8%, and the median was 14.0%. If we invested for 10 years, then the lowest annualized return was a loss of minus 4%. So this would be a loss of 4% each year for 10 years, 10 consecutive years. And the greatest annualized return over 10 years was 19.8%. And again, this would be 19.8% each of the 10 years. The average annualized return was 11.5%, and so on. So let's compare the S&P 500 to US government bonds with 1 year maturity. And in the book, I write this as a stock only for the S&P 500 and a bond only for the US government bonds. So the red one here is for the S&P 500, and the blue one down here is for US government bonds. And as we can see, the S&P 500 performed a lot better than the government bonds. But is this always the case? And it is not. Sometimes the S&P 500 performs a lot worse than US government bonds, and this is one example. So we have a starting date of the 3rd of March 1999, and we have the S&P as a red one here, and it is quite volatile. First it drops a lot from year 2000 to 2003, then it increases a lot, almost catches the bond-only investment, and then it has a huge stock market crash again. So let's look at the probabilities of the S&P 500 underperforming US government bonds. And these are really historical probabilities, or you might say historical frequencies, for the period 1978 to 2013. This is basically the table from one of the previous slides, and we have the years of investing in this column here. And I have removed the quartiles and the average and the standard deviation here. And then we just have the probabilities left. So this is the probability of a loss, that is the annualized return is less than zero, depending on the number of years that we are investing. So let's say we are investing for 1 year in the S&P 500. Well, historically in this period between 1978 and 2013, we would have experienced a loss about 19% of the times. If we had invested, let's say 5 years, then we would have experienced a loss about 14% of the times. And if we had invested for 10 years, then it would only be 7% of the times that we would have experienced a loss on the S&P 500. So this probability of loss decreases as the number of investment years increases. So the longer we have the investment in the S&P 500, the less likely it is that we experienced a loss for the entire period. We can also look at the probability for underperforming US government bonds. So for investment periods of 1 year, the probability was 0.25 or 25% that the S&P 500 performed worse than an investment in US government bonds. And as you can see, the probability decreases as the investment period gets longer. And for a 10-year investment period, the probability was 12% that the S&P 500 performed worse than a investment in US government bonds. So the conclusion is that during the period 1978 to 2013, US government bonds had average annualized return of almost 6%. The S&P 500 had average annualized return of 11 to 13% approximately, and this depends on the investment duration from 1 up to 10 years. But the S&P 500 sometimes had very large gains or losses, and the probability of the S&P 500 underperforming an investment in US government bonds was 25% for 1-year investment periods and 12% for 10-year periods. This is studied in more detail in this book, and you can click on the image or on the link below the video.